So here, this is the VWAP average volume. This study specifically is one that I have not commonly released to traders because I was a little cautious that they would overuse it as a signal for a trade. I think of it more as a confirming layer. I got a lot of questions about, how do you watch volume, or do you incorporate volume or volume profile analysis into your trading? I don't. I'm much more of a, as the name implies, relative or average volume consumer. I just want to know if the volume is higher or lower than it typically is, because that's really what I need to make a decision. I don't need to do the forensic analysis of, necessarily candle by candle or trade by trade. So this study, the VWAP average volume, is going to go at the bottom of our charts. And for right now, I'm going to show this study and hide the VWAP aspect. So I'm doing that by going into the customization options and unchecking show study. That makes it easier to have the study at my disposal, but then to turn it off or on as need be. I'm also going to warn you, this is a particularly complicated study, so it'll take us a few minutes to kind of chop through it, but hopefully I'll be able to make sense of this for you. So the average volume study has 4 different modes. I'm going to go to a longer time frame chart just so we have slightly more data to work with. I'm going to go to a 20-day, 5-minute chart. Oh, I see what's happening here because we had a half day. Right. So there is a small quirk in this, which is it does get a little tripped up on half days for a calculation I'll go into in just a minute. Relative volume you could think of as a volume pace indicator. Actually, you know what I can do? Bear with me one second. I think I can do a custom time frame, and yeah, I'll go back to the 27th. So bear with me one second, everyone. So what I'm doing here is I'm basically looking at just a custom date range, and I'm trying to avoid the holiday period because that tends to screw it up if we're looking at a date that spans one of the half days or holidays. What this study is designed to do, as I was saying before, is kind of measure the volume pace, this idea of measuring how much volume we've totally accumulated throughout the day versus where we typically had traded in terms of volume at that same time of day. So the phrase I use, volume pace or volume schedule, is pretty much a descriptor of whether we are ahead of or behind schedule for how much volume we should be trading for a given day. And what the study does is it starts building an average over the entirety of the chart based on a candle by candle analysis of what's on average for each individual candle. It then composes those into a white average volume line. And you can see this down here on the charts. You could call this the shell, if you will, the white line that has a kind of common swoop to it, almost single helix-like, right? And what it's doing is it's trying to figure out where the total volume traded for the day should be at any point in time throughout that day. Then we display the total accumulated volume as either being blue for when we're above average or red for when we are below average or behind schedule in terms of the amount of volume that typically trades on a day. Now, if you are somebody who wants to look at the kind of minutia and details of this, you can see up here that the average daily volume is plotted, the total volume for the day, and then a differential between the two in both percent and nominal. Now, I should mention this just because I want this to be on the recording too. There is a discrepancy between the total amount of volume reported on an intraday chart by Thinkorswim and the total amount of volume reported to them on a daily candle from the exchanges. I have asked Thinkorswim about this so many times because I thought I was absolutely crazy getting slightly different day total volumes from a daily or an intraday chart. They maintain that it's just a data feed discrepancy and it probably won't affect what we're doing for shorter term intraday trading. My rationale for why this discrepancy is acceptable is because we are relative volume traders. We're not necessarily measuring absolute amounts of volume. Does that make sense? We just want to know whether we're above or below expected volume. So if that's slightly different on a kind of nominal basis from the amount of volume that's reported on a daily candle, as long as our intraday candles are appropriately or proportionately lesser than that total volume that's presented, and we're using that same data intraday, it's just a relative comparison. Meaning, again, it's just above or below average. Even if that average is skewed, we kind of assume that it's skewed on the average side as well as skewed on the intraday detection side as well. The idea here, again, is that we're trying to figure out, is this a big volume day or not? And how early in the day can we figure that out? So those are the two questions. Are we above or below average? And then can we find out pretty quickly? Because the benefit of something like this is that knowing early in the day, where I'm drawing down here at the bottom of the screen, that we've started to separate and outpace our volume average, I would confirm for you, if you didn't have it before, the idea that there is likely more wind in the sails, so to speak. There's likely more opportunity for a directional trade on those higher volume days. You can actually look back here as well. Pretty volatile day, big range. Same thing here, big range day. And so what this is, again, designed to do is a confirmation layer for, are we in a trend or high volatility environment? Remember that volatility can be directional. When most people say volatility, they picture chop, back and forth. But we can get directional volatility, right? When a market picks a direction and moves 5%. That's absolutely volatility, wouldn't you agree? So again, this study is designed to be used on an intraday chart, typically at the 1 or 5 minute granularity, meaning that's how big I want my bars to be. So I can get a lot of data or a lot of instances of reporting back to me whether we're above or below average volume. If we were to look at this on maybe an hourly chart, we'd only get a couple candles or a couple prints of the indicator to judge whether we're ahead of or behind schedule. So let's go in and take a look really briefly at the settings for this study. This is going to be extremely confusing if this is your first time looking at it, so feel free to take your time, ask questions, and kind of walk through this option by option. But our main two options up here are average type and display type. For display type, we've only got two options, absolute or relative. For average type, we've got 4 options, day, bar, rolling, and $%. We've just looked at the day absolute variant. So what that means is the total day's average volume on an absolute basis, meaning we can see 2.66 million shares traded against an average of 2.06 million. We can actually see some volume numbers, right? If we were to change this to relative from absolute, what we're going to observe is that the indicator changes to reflect it on a relative or a more comparison basis. So notice that it's only going to describe whether we are above or below average, like an oscillator or like an indicator. And people will say, well, what's this number? This is the percentage differential above or below the average. So you can see here the 28.69% above average, 28.7% above average, etc. And you can see here it's a visually very different look and feel from the absolute variant of the study, just because I didn't want people to get confused as to what they're looking at. You can actually see up here, this label will change to display whatever variant you are currently looking at. So when I change it back from relative to absolute, you'll see that the day cumulative percent changes as well. It now should say, yep, day cumulative versus average. When we change this from day to bar, what we're shifting is we're changing from a daily accumulated average volume to a bar by bar comparison. Now, when I say bar by bar comparison, this is actually a request from one of my students. They said, hey, Zach, if I'm trading this bar, let's just call it the 1 o'clock bar, 1 o'clock to 1:05, How does that bar compare on average to the 1 o'clock or 1 o'clock to 1:05 bar on the prior day and on every day previously? It's looking backwards at that specific bar historically to evaluate whether that current bar is trading above or below average. So let's take a look at that. We've made the change. Now we got to click apply or OK here. We've got a very different look and feel to the study. So I'm going to make it a little bit bigger so everyone can see. Notice that there are two colorizations that the bars can receive. Gray for if we are below average, and blue for if we are above average. I think I made it so that all these colors are customizable within the study itself. So if you prefer different colors, totally fine. The yellow hash marks are the individual bar average for that one bar. So let me try something actually, rather than maybe a 5-minute basis, which might be a bit too granular, a bit too detailed, although we can kind of see that there's the traditional volume scoop that we would expect, big volume in the morning, big volume at the end of the day, and a little bit lighter average volume in the middle of the day. At a small time frame like 5 minutes, this might be a bit hard to detect. So let's try maybe going to the 30-minute time frame. How do I want to do this? I want to scale this chart a little bit better. So at a glance, what this shows us is the number of bars, or the likelihood of, I shouldn't say the likelihood of a bar, but the number of instances in which a bar trades above its specific bar average at that time frame. So now we're looking at 30-minute buckets of data at a time. Notice that it's pretty rare that we get a significantly above average volume in the middle of the day. I would want to know what happened during that candle, so I would want to go in and look at a more granular time frame now that we've kind of identified it on the 30-minute window. But you can see here, this is a much bigger range day. This is one of the higher volume days we had looked at. And you can actually see down here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of 13 candles. The majority of the candles for the day, as you'd expect them to be, were above average volume. Now, I don't particularly use this, but if you are more of a higher time frame trader, 15, 30 minutes, maybe an hourly, this could be really helpful for figuring out how are we trading over the course of just the past hour. Are we trading above or below expected volume for that specific time window, specific time zone? And again, there is an option within this study to change it from absolute, which shows us the actual volume numbers, meaning the actual volume for that candle and the actual expected volume for that candle. We can change it to relative and get another display type. Now here, again, a bit confusing at first, but I've always color-coded everything, right? Dark gray bars are bars that are far below the average bar size. Notice that this is displaying it as a ratio, not as a percent. So what this will do is it'll compare all the bars that you're seeing to their own specific bar average, and it gives you both the 1.0 level, which, as you might imagine, a ratio of 1 to 1 means that bar is the same as the average for that bar. But it also gives you a user preset, this 1.2 level, which if we wanted to, we could go in and change. Let's change the vol ratio threshold to 1.5. What that means is now we're going to see this bar raise up to the 1.5 level, and it will only highlight in blue bars that are, greater than 1.5 times their bar specific average volume. So our three colors again are gray for way below average, light gray or white for above average, but not above the user threshold, and then blue for when we are far above the threshold. The first two modes that I just went through are the most, I think, useful, day and bar, day being the total days accumulated average volume, bar being the bar specific average that we just went through. The other options are rolling, which is a typical periodic average volume. It compares the volume of the last 20 candles, let's say, to the current bar's volume. I don't think that's particularly valuable, but I included it just in case somebody wanted to use that variant. And then dollars percent. So let me just show you this very briefly because I think it's kind of interesting to be able to see. This shows us the total amount of volume expressed as a dollar sum on a candle by candle basis. And again, we've got a user threshold somewhere in there. Yep, the money threshold in billions. So you can define candles that traded more than a certain amount of volume. These speech bubbles, by the way, at the end of the day, are the day's total. So just to be crystal clear, this was 444 million traded for this entire day. Here we see 521 million traded for this entire day. And I believe if we change this to relative, yep, that re-expresses the bars. I'm going to actually switch to a lower time frame now so we get more granularity. So I'm going back to a 5-minute chart. Yeah, this expresses the amount of volume traded for each candle as a percent of expected average day volume. So you can actually see that over here where it says percent of average day volume. So this shows each candle as a typical, or what to expect in terms of the percentage of, as the name implies, the average total day's volume. And you can see kind of here that there are big candles at the outset and big candles at the close, and a kind of scoop of volume in the middle. We've all experienced that, right? The volume dries up towards the middle of the day. I guess the thing I'd want to underline about this study, again, is that we use this for confirmation, not for trade identification. I'm not going to be taking a trade because I see there's high volume. I would be more likely to take a trade if there is higher than average volume, meaning if I had already identified a trade, right? The other thing I would recommend is try and use this on the smaller time frames, but larger charts. So for example, a 20-day chart with a 5-minute bar size, that sounds pretty optimal to me because that gives you a lot of context to build your average, but also very fine data with which to build the average. You're not dealing with big blocks of data like an hour at a time.